How to invest in the S&P 500 even if you're a complete beginner. Have you ever wondered how ordinary people build wealth without spending hours picking stocks? The answer for millions of investors is surprisingly simple: the S&P 500. Today, I'll explain what the S&P 500 is, why so many people invest in it, and how you can get started, even if you're a beginner. Let's begin. The S&P 500 is an index that tracks approximately 500 of the largest publicly traded companies in the United States. These aren't just random businesses. They include many of the world's most successful companies across industries such as technology, healthcare, finance, consumer goods, and energy. Instead of trying to guess which single company will outperform, investing in the S&P 500 gives you exposure to hundreds of leading companies in one investment. That's one of the biggest reasons investors like it: diversification. If one company struggles, the overall impact on your investment is usually limited because your money is spread across many companies. Now let's talk about the benefits. First, the S&P 500 has delivered strong long-term returns over many decades. While no investment is guaranteed, history shows that staying invested over long periods has generally rewarded patient investors. Second, it's simple. You don't need to spend every day studying financial statements or watching the stock market. You simply invest in an S&P 500 index fund or ETF, and it automatically follows the performance of the index. Third, the costs are usually very low. Many S&P 500 index funds charge extremely small annual fees, which means more of your money stays invested over time. And finally, it saves you from trying to predict the next winning stock. Even professional fund managers often struggle to consistently outperform the market over long periods. So, how do you actually invest? The first step is opening an investment account with a regulated broker available in your country. Next, deposit the amount you're comfortable investing. Then, search for an S&P 500 index fund or ETF. Instead of buying individual companies one by one, you'll own a small piece of hundreds of businesses through a single investment. One strategy many investors use is called dollar cost averaging. This simply means investing the same amount of money on a regular schedule, such as every week or every month, regardless of whether the market is up or down. When prices fall, your money buys more shares. When prices rise, your investment continues growing. Over time, this approach can help reduce the impact of short-term market fluctuations. It's also important to remember that investing is different from gambling. The stock market goes up and down. Some years are excellent. Some years are difficult. The key is to think long-term instead of reacting to every headline or market drop. Patience has historically been one of the greatest advantages an investor can have. One final point: never invest money you'll need in the near future, and always do your own research before making financial decisions. This video is for educational purposes and shouldn't be considered financial advice. If you found this video helpful, consider subscribing. I'll be sharing more videos about investing, building wealth, ETFs, the stock market, and practical financial education. Thanks for watching, and I'll see you in the next video.